Hey YouTube, it's Dimitri, and today we're going to talk about risk appetite and how to set one up, also along with what is the purpose. And then I'm going to cover 3 examples here, going into a small banking example, a hedge fund example, and of course a manufacturing example. So something a little bit different than what we typically cover on this channel, which is focused mainly on finance. So the purpose of a risk appetite, I'm going to call it a risk appetite statement in the sense that it should be something short, concise, to help the entire firm grasp and understand it and use it. If you create a large document, like a 5-page document, a 30-page document, or larger, people aren't going to grasp what the risk appetite is, and it's going to be this cumbersome document that gets stored away on some corporate server that no one's going to look at. So the purpose of a risk appetite is really to set guardrails on what the business wants to be doing. What risks should we be seeking that we want to take as part of our daily business, right? Everything we do in business, there's going to be some sort of risk. There's a core function of the business that we're focusing on to make a profit, provide a product, provide services, better customer service. All that's going to focus around our daily business here. And we want to take those. We don't want people coming to us constantly saying, oh, we have this new risk, process or risk team in place. I need to get approval for everything. That is not good. Risk management should not be in the way, choking out the daily business. So the risk appetite helps set what is the daily operations, what we should be doing. On the flip side of that, it should also set some guardrails of these are things that are outside of the realm of the risk appetite. If we want to take additional risks, we want to pivot, do something unique that's not part of our core business, we need to actually focus on a committee, getting senior management involved in that. So the risk appetite is really to bring everybody firm-wide together to allow everyone to do their jobs without having a lot of management or risk management involved in this process of doing your daily job, right? Nobody wants to be babysat and get permissions for that. And there's going to be this gradient here, which we see on this slide, where we have the risk acceptance. Everything in the blue is like the daily business. That's what we're working on. Everything above this avoided risk on the red side and orange side of this is things that we already know we don't want to do. And then there's always going to be this gray area of uncertainty just because that's the real world, right? We don't know what is available. We don't know what the future holds. And there's going to be this area where we're going to need risk management and senior management involved to make decisions on where we are headed as a business. So how do you create a risk appetite here? There's really 4 questions I would ask yourself. Again, risk appetite should not be designed by just risk management. It needs to have the senior leaders in the corporation involved, as they're the ones that are going to be driving the profit, the daily business. Your executive team should really be heavily involved in this because they're the ones that see the vision of where the firm is headed, right? That's the entire purpose of this, is planning, which we'll talk about later. But the 4 questions are going to be, how does the business make money? What is the risk reward trade-off here? So finance is much easier, and we'll do some examples as I mentioned here in a second. But understanding what is the daily business? What are we making money doing? What are the risks involved with that? And it could be financial risks like, interest rates adjust or move. It could be cost of materials change. Those are sorts of risks that we look at. Also bad customer service or poor customer outcomes. These are also risks like reputational damage, branding damage. A lot of these other risks also tie into our core business here. So you can even have this applied to marketing teams, for example, media outlets. There are other parts of this, but it covers the entire business. And we just need to write down what is our core business and how do we make money. And that leads us to what risks should we be taking on a daily basis, right? Obviously, as we do business, we're going to take risks. There are a whole slew of risks that we want to take because that's how we're making money. That's how we're creating some sort of value for our end customer here. And then the third question is going to be, what risks should we avoid? So often it's easy to think of crazy risks like, okay, we definitely don't want to end up in this sort of market, or we don't want to end up taking on excessive risk in this area. That's something that should be listed in this risk appetite as well. And then finally, can these be quantified in something to make it a little clearer to employees firm-wide here? So we're really looking at, how do we make money? What risk should we be taking? What risk should we be avoiding? And are there any sort of thresholds we can set in place to make it a little clearer for those that are going to be using and understanding the risk appetite? So let's dive in here with a small banking example. We're going to just call it Bank ABC. Their core business here is really going to be retail loans, checkings, and savings accounts. So again, retail loans can be like mortgages, auto, all these sorts of different loan products here. But for their risk appetite here, we're going to say the expected C&L for mortgage is 8% with a 15% maximum. Auto, meaning automotive loans, is expected to be 15% C&L with a 20% maximum C&L. And then personal loans is expected to be 20% CNL with a 30% maximum CNL. Again, we're setting some thresholds. We have different products that are the core function of the business here. We're just kind of laying these out on where we want to be. And of course, we're going to have a target, which is what we're running the business to. And we're going to have some sort of threshold that, if we deviate, the market moves, there's some flexibility and it makes the business reasonable. The last thing we want to do is choke the business out by putting too many restrictions or too tight of guidelines and quantified numbers in place. And then every time we bumped up against these a little bit, people start panicking and kind of running, crazy and bringing in too many people in this process here. There's no reason to have fire drills just for the sake of fire drills. And again, Bank ABC has a moderate credit risk appetite, seeking to help a mix of subprime and prime customers here. So this is what the core business is, right? It's a bank. We understand we want to take on credit risk as a moderate risk in itself, and we'd like to focus on a good, solid mix of subprime and prime customers. This helps define what the business does, as we just talked about, the risk we would like to take, which is going to be the credit risk. And then we're going to look at the second part of the statement here, which is going to be the risk that we would like to avoid here. Bank ABC's risk appetite for fraud, data security, and market risk is very low. The risk appetite for operational risk is moderate, as the bank is focusing on increasing operational efficiencies with AI while minimizing operational losses. So again, you're kind of looking at this risk piece like, okay, we need to put a lot of time and effort around data fraud, security. 1, these help our customers. 2, this helps with regulations. And 3, this is a reputational risk in itself, right? It can be very damaging as a firm or a small bank, even a large bank, for example, if you have some sort of data issues or fraud or any sort of these things. Again, the market risk portion as well tells them that they're not looking to get into the investment sides of this. It is primarily for banking purposes only. And again, the operational risk is going to be moderate, meaning they're trying to implement AI in some sort of safe, functional manner. That might be an annual goal the company is looking to hit. And so they're looking at bringing all this in here. But again, it makes it into this risk appetite statement, so everybody feels comfortable moving forward without having to get too much senior management involved with this. And here are 3 examples here so we can kind of understand how these will happen in practice. A customer wants 2 mortgages on different investment properties where each property is $450,000. So does this fit in our risk appetite? The customer fits into this because they are a retail customer. They're not operating as an LLC or a business in itself. Again, if you have loss models and they predict the expected loss is 6.5%, and mortgages are a core product here, no red flags, right? It's the core business, the core product. Might be a little bit unique because it's one individual purchasing a few different properties or assets, but it all fits the business, core business plan and the risk appetite. So there's really no need to get any additional senior management involved unless you had other rules and restrictions in place for some reason. So this is a business as usual case. Perfect example of, credit team, go do your thing, go do your business. There's no reason to get a bunch of people involved. Second example here is a current customer wants an auto loan for their small business. Again, it's an auto loan, doesn't seem very irrational, but corporate is not their core account here. So since corporate is not part of the core business, and in the risk appetite, it says they're mainly focusing on retail, now there should be a discussion probably involved in the business of 1, does this align with the risk appetite? 2, are there any exceptions that we need to be changing or adding? And then thinking about this from the perspective of, we might be making a pivot. Maybe we say, okay, we're going to allow small businesses, maybe sole proprietorships and LLCs, less than X amount of dollars, right? You're starting to change the vision and the direction of the firm. Again, your risk appetite might need to be updated as you make strategic decisions or changes in the business itself. So again, this is an example of it's outside of the risk appetite. Getting the right parties involved will need to happen. Again, this doesn't need to go all the way to like the executives or CEO or anything, but you might bring in, for example, like your head of credits or strategy, your pricing teams, trying to figure out like, do you have models? Do you have the resources? And how are we going to handle these new sorts of situations? Again, it's an additional risk, right? There's a risk involved that we might not have a model to price this. So if we're using retail models, there's going to be a risk associated with that. The third example here is a vendor AI bot is being considered that would answer common customer questions and reduce operational costs and headcount. This fits in the risk appetite for a moderate risk. Nothing seems crazy out of the norm here. The operation team will need to review the potential risks associated with the bot as well as the potential cost savings. So this is not an excuse to quickly make decisions, right? You're going to need a full analysis and look at the risk itself as that department and look at the risk reward trade-off here. But you're not going to need to get in the risk department. You're not going to need to get in senior management for this unless there are other reasons or getting buy-in or those sorts of things. But the risk appetite in this example should not be restricting you at all, right? But you should be going to this business as usual. But I do want to point out this is not an excuse just to make decisions and run wild and then use the risk appetite as an excuse. You still need to do your job and look at your risks associated with implementing some sort of new AI tool. Is it the right tool? Vetting the vendor, doing due diligence, all that still needs to occur because that's just part of our daily business here. Now let's jump into a hedge fund example here. We're just going to call it Fancy Quant Capital for the sake of it. Fancy Quant Capital provides investors moderate risk exposure to hard assets while keeping operational risks low. Market and economic risks are expected to be high due to the nature of the business. However, credit risk should be moderate overall, as a high risk exposure to consumer and corporate defaults will be balanced out with low credit default risk commodities. So what it's telling you is what is the function of the business here, right? It's a business that's looking to invest in hard assets. So hard assets can be commodities, loans, because loans are always backed by things like mortgages, like houses, cars, even crazy things. We'll get into a few examples here in a second. The focus here, again, market and economic risks are expected to be high because it is a financial institution working in hedge fund markets. Again, economics drives a lot of the credit side of the business. So when the economy is great, credit defaults are low. When the economy sucks, you have really, really bad credit issues and defaults and high correlations across the field. So this is something that they already understand. This is part of the daily business here. And then it highlights some of the business and some of the functions and risks itself. So again, you have high risks associated with consumer and corporate default. So you're making loans, you're going to have really high credit risk on this side of this. But you're wanting to balance this out with lower credit default risk from commodities market. So we're looking at assets here. The business is saying we need to ensure that we have some sort of risk practice in place such that we're taking commodities as kind of a hedge to hold value. So this is a strategic decision. This isn't like commodities magically are just safe and easy. It's how you use those and how you purchase those and how you select that sort of commodity to balance out higher risk exposures from things like auto, mortgage, maybe sheds, power sports, some of those other products here. Again, trying to use these two levers strategically. This is just the firm's strategic vision, and it's how it's kind of slicing and dicing the risk and how they're going to be taking on risks and, again, what they're wanting to avoid here. So let's give some examples. Again, FQC wants to purchase $100 million in subprime consumer products through a private ABS, which is asset-backed security deal. Assets include power sports, sheds, trailers, and RVs, which are all very, very high risk if you're curious. This investment falls within the risk appetite as long as there is some sort of balance in lower risk hard assets to offset this position. So again, what it's saying is the business is trying to seek out profits by taking on hard assets. Again, these are very high risk ones. So strategically, as the business said, it needs to find some sort of balancing low risk to counterbalance that. It could be in commodities, as it mentions in the strategic statement there. It could be in something like prime or super prime mortgages. It could purchase like an A tranche of another asset-backed security or mortgage-backed security to cover that. Again, I'm not going to get into the business. I'm not the business here, but these are the decisions you need to think about with your risk appetite in mind. Again, a full risk assessment of this needs to occur to figure out how this fits into your strategic business plan, right? It's not an excuse not to do your job. It just provides some sort of operating guidelines that senior management's happy what you can and can't do. And then you're not also bugging them and you can kind of run free and make decisions on your own as the business. Second example here, FQC wants to purchase a small investment company that is in Chapter 11 and specializes in commodities. The company currently holds $250 million in physical wheat, corn, and soybeans. This is not part of the risk appetite. Again, we talked about earlier hard assets itself. It does not talk about purchasing businesses, right? This is kind of like a gray area where the business holds a bunch of hard assets. So it's almost like we're purchasing the hard assets depending how we go and structure this sort of deal here. FQC is in the investment of hard assets, not corporations in themselves. So this would need to go to a senior management discussion, a risk committee to talk about like, how do you go about this process? Are they going to buy out the full business? Are they going to try to do a liquidation and move it into Chapter 7? There's a lot of moving parts and pieces here. Again, this is an example of something that's adjacent to the daily business, but it has some nuanced issues and it's, in that gray area or a little bit outside of the risk appetite itself. And so there needs to be some decision making at a more senior level and also at a risk level to make that final decision here. Third example is going to be the operations team is wanting to buy an AI tool to automate trade documentation. So the trading process has a lot of documentation that goes into it. The team needs to get senior management involved in the decision making, as this again is outside of the risk appetite, which they said was their operational risk was set as low. That was the piece they wanted to just nail down, be very, conservative in. But now as they're starting to do automation and efficiencies, this looks like a great opportunity. It would help them, run the business more efficiently. But it's going to be probably a moderate or high risk, depending on how the analysis goes in this process. You need to get more stakeholders involved in this process of making the decision, picking the vendor, and determining if this is something you want to do, or maybe the trade documentation is very limited in the business because it's making bigger, trades or transitions here within these assets. Things to consider when you go through this process of kind of your risk appetite and how that fits your business and your business model. And then a manufacturing example here. So let's say we make a company called Steel Auto Parts, and it produces high quality aftermarket automotive parts that meet or exceed OEM parts. SAP, which is the name of the company as we've abbreviated, has a high risk appetite for raw material prices, a moderate credit risk appetite, and a low risk appetite for data security, product safety, consumer experience, and operational risks. Again, you're defining what is the goal of the business. It's to make high quality auto parts. The risk that you want to take, you can look at with the high risk appetite piece here, which is going to be, raw material prices, which we'll look at here in a second in the examples. A moderate credit risk appetite. So depending how they're involved in credit markets, they might understand this as part of doing business. And they're not wanting to be a financial institution, so they don't want high credit risk. But they also understand they're going to need to do that to really kind of push and grow the brand if they're in a growth phase of the business. And then again, the pieces they would like to more or less avoid are going to be these low risk appetite pieces, which is like data security, product safety, consumer experience, and operational risks. So 3 examples for this is going to be a product manager decides the company needs to add an EFI gas tank to their product line. EFI is electronic fuel injection if you're out of the realm here in the automotive space. But while a new product might require other departments' approvals, right, getting in engineering, pricing, materials, and all that, this doesn't necessarily go against anything in the risk appetite. It's just growing the product line, and it fits within that core function of building new products that meet or exceed OEM standards. So this is great. This is the business doing the business. No need to really get risk involved or senior management. But you do want to get, of course, your stakeholders involved in this whole process. They're going to be involved in this, but this is not really a risk issue within itself. The second example is going to be the finance department wants to purchase HRC futures. So HRC is hot rolled steel futures contracts to hedge the risk of steel prices rising due to some new tariffs that got implemented. Okay. This does not align with the risk appetite. So when we went back and looked at the risk appetite, we had a high risk appetite for raw material prices, meaning we want to take on that pricing risk. We don't want to be out there hedging and spending a lot of time trying to be extra safe around prices. The business might feel that it can pass these costs along to consumers because all the competitors are going to be hit with similar tariffs and issues here. Again, this needs to be discussed with management. Like maybe there is this new tariff, they weren't expecting it. It's really going to impact the firm by 30, 40%, something large, not like a small move we've seen in the past. Again, this would require senior management and the risk committees to kind of get together and discuss like, okay, the finance department sees this big risk. What should we do about it, right? So again, it's outside of the risk appetite, and it's a great example of when you would want to get everybody involved in this case of managing your risks actively. The third example is going to be a large corporate customer wants to move their accounts payable from 60 days to 100 days to better align with their inventory turnover. Again, the credit risk associated with the decision would need to be reviewed and discussed with the finance and accounting teams because it's going to impact them and how they do their jobs and their business and how they kind of operate as the finance and accounting departments. But it may fall into the moderate credit risk category, or it might be viewed as a high risk or a low risk depending on the customer and the outstanding amounts. Again, risk appetites aren't really cut and dry of like, yes, no, based on a specific statement. They provide some sort of guardrails and guidance, and it's always going to require the business and the business's expertise to really come in and classify the risks themselves, right? Maybe it's a huge, enormous customer, looks like very, very low risk. Go ahead and do it, right? There's really no risk to get everyone else involved in the risk team and say like, hey, we're going to make this, accounting and finance decision and make an adjustment. Doesn't require them. But they also might come into this and look at and say, hey, it was a company-wide policy. Maybe they also work directly with customers that are like retail customers, right? Are they going to allow some sort of delay with retail customers? Probably not. You're going to want to collect all that up front. These sorts of decisions, though, if they're viewed as a high risk, would need to be discussed with, again, the correct people and the department itself that's actually be making these sort of decisions, which is a finance and accounting in this example, needs to kind of categorize and quantify their risk and be able to justify it before moving forward with it. So what are the benefits here that we have seen with the risk appetite? Again, it helps you with your annual planning and your long-term planning within the corporation. So many well-developed firms that have really good risk management practices will actually use this every year. They'll come back as a group, as a planning committee, and the risk appetite just happens to be a bullet point on the agenda of how we fit together and adjust the risk appetite to align with our current goals. As you saw with some of these examples, you might be getting into a new market. You might be changing a little bit of like the core business. You might be, cutting off a division, doing something like that. Your annual goals and your long-term 5-10-year plan should align with your risk appetite. And then, of course, you need to adjust it as need be. This isn't something like you just set it once and you're done for 10, 20 years. It's something that you set up and you align with the core business so we can make money, but also have some guidelines to kind of manage the risk. Again, it also provides authority to the divisions to do their daily job. So I think one big misconception we see with a lot of poor risk management implementation is you get someone in risk management who's very eager to manage the risks and do the job, and then they choke out the business themselves and they put so many constraints and restrictions on it that everybody's irritated and nobody wants to do risk management. That is not a good scenario here. A risk appetite is really a way to find the perfect balance between the business and the risk side, and it should be set in stone up front. So I'll tell you this with investing companies as well, or even companies I've worked on the manufacturing side. Often a good opportunity comes along and like people just want to run with things and do something crazy, and they're always moving the thresholds around. And they do that because they're trying to make an extra buck, increase their salary or their bonus for the year or whatever. And they often don't look at things in a longer term, like annual 5-year plan trajectory of understanding the business itself. And so the risk appetite itself kind of prevents that, right? You sit down logically without a lot of pressure and opportunity and excitement, and you sit down boringly at the beginning of the year and you set up these statements to figure out where we're headed. They help keep you in check so you don't get overly excited about some sort of new opportunity where you might take on too much risk, just excited that something's new or available. But in general, it should really reduce management's time and having to go and check every single project because you have too much risk management. It also, on the flip side of that, you don't want the business to be so wildly free that they're taking all kinds of risky decisions and then senior management is upset or the risk teams are upset saying like, we didn't agree we were going to do any of this. We're taking on a bunch of risks. Maybe we took on a bunch of losses on top of it because nobody communicated. The risk appetite is really there to kind of help balance and get everybody on the same page. Again, it manages your risk and embeds risk culture as well. So one thing I think a lot of smaller firms or firms that are newer to the risk management space don't understand, risk management is not a department's job. Risk management's job is to set up frameworks and, explain things and put everything in place and monitor and all that. But risk management is part of the entire fabric of the business, right? Every employee should understand what their job is. They should understand the risks they're taking, why they're taking them. And a risk appetite really helps build that cultural piece. So everybody feels like they're involved and free to make decisions, but also they understand where the thresholds and the guidance is and why risk management as a whole is an important practice. The risk appetite also, I think, is like the first document that should be really created in the risk management process of building out a risk team. Again, a lot of big companies do this annually and it kind of sets the tone of where we're at. On top of that, then you can start to build out more detailed documents and risk committees. So for example, you can have a risk management committee that sets up like thresholds for different departments. Maybe it's the credit thresholds, operational thresholds, losses. There are other committees that can be involved and set up, but having that risk appetite is like the guiding principle is a good piece of that. Other pieces that can be built out is like your risk inventory, your policies, and your procedures. Again, everything should align under what the risk appetite is going for. The risk appetite is just a very generalized statement to help you start. And then you can build out other things like risk topology, risk committees, setting up inventories, governance, and all the other parts and components underneath of that. Anyways, I hope you guys found this video a little bit helpful. Do not overcomplicate the risk appetite statement. It should be short and concise, should tell you what the business is doing. It should list out the risks you want to take, the risks that you want to avoid, and it should really help guide you as a firm in actually running the firm itself. It should not be this big burden. If it is a large burden, you're not doing it right. So anyways, If you found this helpful, don't forget to like, share, and subscribe. You can also find me on my website at fancyquantnation.com, or you can email me at fancyquant@gmail.com. And of course, I'm on LinkedIn as well. So thanks for watching, and as always, until next time.